Wow. If you've been watching the tickers lately, you already know that a massive, multivariable macroeconomic shock just absolutely rocked the global markets this July 2026. We basically just witnessed a seismic shift in the financial landscape. So, welcome to this explainer, where we are going to dive right in and dissect the anatomy of this perfect storm. Just think back to that staggering intraday reversal. At exactly 2 p.m., Chairman Warsh and the Federal Reserve released their policy decision to hold rates steady. Now, initially, we saw a brief relief rally. But when Warsh dodged direct inflation questions and asserted his preference for a, quote, quieter Fed, well, market trust evaporated right then and there. I mean, the Dow literally plunged over 1,100 points in a flash, sparking this incredibly violent sell-off across both the S&P 500 and the Nasdaq. Seeing a sudden reversal of that magnitude really begs a question, right? What underlying forces collided all at once to cause the most severe momentum crash in modern history? Because, a crash like this doesn't just happen in a vacuum. It's like a giant puzzle requiring a perfect, almost fragile alignment of vulnerabilities. So today, we're going to map out this complex puzzle step by step. We'll be covering the collision of forces, policy and energy shocks, the AI reality check, the historic market momentum crash, hidden winners and resilience, and finally, repricing global capital. All right, let's jump right into part one, the collision of forces. You see, this wasn't just some single isolated event. It was actually the violent synthesis of four distinct pillars colliding all at once. First, we had the Fed's communication void triggering a massive yield curve steepening. Second, a big tech divergence, where markets suddenly woke up and started separating actual AI winners from unproven spenders. Third, Middle East energy shocks acting as a massive, immediate tax on the globe. And fourth, a violent momentum crash rotating capital out of high beta tech. These four forces basically just fed straight into one another. Moving on to part two, policy and energy shocks. The physical origin of this whole renewed inflation threat, it actually started with geopolitics. Severe missile exchanges between the US and Iran spiked global crude futures by nearly 8% practically overnight, pushing prices way past $90 a barrel. With these new theaters of conflict opening up and shipping lanes through the Strait of Hormuz suddenly threatened, this energy shock acted as an immediate global tax. It completely paralyzed the Fed and reignited inflation fears in an instant. And because the Fed effectively refused to hike rates against this war-fueled inflation, the bond market threw an absolute tantrum. We saw a dramatic steepening of the yield curve. Investors were essentially screaming, hey, if you won't fight inflation, we are going to demand massive premiums on long-term debt. Interestingly, the 2-year yield actually dropped, but the 30-year yield, it spiked massively to 5.24%. That is the highest level we've seen since 2007. And that steepening fundamentally threatens equity valuations everywhere because the cost of long-term capital just got significantly more expensive. But here's a really fascinating divergence for you. While global energy prices were skyrocketing, this structural bottleneck actually heavily advantaged U.S. domestic natural gas. Because expensive, super slow-to-build LNG export terminals act as a structural barrier, U.S. domestic onshore gas prices actually dropped 33%, while prices in Europe and Asia literally doubled. This created some massive, hidden tailwinds for energy giants like ExxonMobil and Chevron, absolutely, but also huge advantages for downstream industrials like Dow and heavy manufacturing companies like Nucor. They now get to enjoy incredibly cheap domestic energy inputs compared to all their global competitors. Okay, let's turn to part three, the AI reality check. Right in the middle of all this, investors got absolutely ruthless about separating the pack in tech. On one hand, Microsoft is being crowned the true AI winner. They've got proven cloud returns and rising Copilot users sending their shares up. But then you have Meta, who got brutally punished as a CapEx black hole. When they raised their 2026 CapEx to over $130 billion, with super vague monetization plans, the market retaliated swiftly, sending their shares down nearly 10%. Make no mistake, Wall Street's tolerance for blind AI spending is officially closed. And it's not just a software problem, either. Generative AI has hit a very real wall of brutal physical constraints. Over on the silicon side, we're seeing handset revenues down 20%, which is forcing companies like Qualcomm to make some major pivots towards automotive and IoT. And then there's the power grid fatigue. Just look at NextEra and Brookfield's $100 billion project in Kentucky. It highlights the staggering 1.2 gigawatts of compute power required right now.
The massive physical infrastructure needed for AI is running headfirst into severe limitations in manufacturing capacity and power grid capabilities. Honestly, deep investor fatigue is setting in.
Which brings us to part 4, the historic market momentum crash. So the fallout from all this rapid tech repricing was a violent divergence in equity strategies. Capital aggressively fled high beta momentum stocks. The semiconductor ETF alone dropped 5.4% in a single day, and that money poured directly into equal weight safe havens. The S&P 500 equal weight ETF, the RSP, actually hit all-time highs. It logged a 12% year-to-date return versus the standard SPY's 7%. This marks one of the most violent rotational extremes on record as money sprinted away from crowded AI winners. But what was really driving this violent crash was extreme underlying vulnerability in market sentiment. Just before this unwinding, the ratio of volume in leverage long versus short U.S. equity ETFs had totally surged. In fact, it matched the sheer desperation and greed we last saw during the 2021 stimulus frenzy. Think about that. When you have disproportionate, heavily leveraged bets on the upside replacing rational allocation, you get a highly reliable leading indicator for a market top. And that extreme positioning was completely punished in July.
But it's not all doom and gloom. Let's look at part 5, hidden winners and resilience.
Despite the momentum crash, one major silver lining we found is the massive operational leverage being unlocked right now. Traditional scaling used to require linear headcount, right? Well, AI is completely breaking that link. According to some stunning new platform data from Stripe, there are now thousands of single-employee businesses, these solopreneurs, generating over $1 million in revenue without any traditional payroll overhead. This cohort actually doubled in size between 2023 and 2025. It is an absolutely fascinating display of exponential output driven by AI administrative and coding tools. Also, surprisingly enough, the global consumer is showing some shocking resilience. They are continuing to outspend inflation, specifically when it comes to experiential events. Take a look at EB InBev's Q2 performance. Despite elevated borrowing costs and global tension, they posted $16.66 billion in revenue and solid volume growth during major 2016 sporting events, like the FIFA World Cup and Wimbledon. This robust, event-driven spending is actively easing a lot of Wall Street's fears about shifting generational consumption habits. Bottom line, people are still happily spending on experiences. Finally, part 6, repricing global capital. Let's tie these cross-currents together. When you step back, you see that all of this builds into a vicious, continuous feedback loop. Step 1, geopolitics and the Iran conflict spike crude oil. Step 2, that oil-driven inflation paralyzes the Fed, steeply pushing the 30-year yield up to 5.24%. Step 3, those higher yields crush valuation tolerance for massive, unproven AI capital expenditures. And finally, step 4, that tech sell-off triggers the severe momentum crash, forcing capital to rotate heavily into equal weight safe havens. So if you take absolutely one thing away from this explainer, make it this. The entire financial paradigm has violently shifted. The era of growth at all costs is dead and gone. The market now absolutely demands capital discipline and real yields. If a company can't prove its return on investment today, the market is no longer willing to just blindly fund its promises for tomorrow. And the dust definitely hasn't settled yet. Just look at the immediate 48-hour catalysts coming up. At hour 12, we get the BEA's June PCE index, which is the Fed's preferred inflation gauge, and advanced Q2 GDP. By hour 24, the Bank of England's global policy rate announcement drops, and at hour 48, we get Apple and Amazon earnings, which will basically be the absolute final verdict on consumer demand and Q2 AI infrastructure spending. These massive data drops are going to strictly dictate the next leg of this market move. So as we wrap this up, I want to leave you with one final provocative thought to consider. Will this structural rotation toward capital discipline hold as a permanent new era in the markets? Or, with a lot of the leverage finally flushed out, is the market fatally underestimating a massive momentum bounce? The real answers lie in how these tech giants justify their spending in the coming days. Keep your eyes on the data.